Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast, our weekly 2 cents segment. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from Flint Group. Chris, how was your Easter?
It was good, Pete. If you listened last week to our episode, I was driving to Melbourne and we got back safely, which was the result you want, but it was a very long drive back yesterday. It's Tuesday, we're recording this now. And it was a rapid fire down there, saw the parents, went to Dinosaur World, went to the proper dad day. You know, my wife had to go and see one of her friends and we were driving past Le Mans go-karts and I sort of went, am I going to do it? Am I going to do it? So I took the kids in there so I could get to go on the go-karts, which was a bit of a sneaky dad trick there. But coincidentally, they did have a go-karts for 4-year-olds, so my daughter went on that. But yeah, it was a good little trip down there and it was a cracking weekend. Melbourne was on fire. It was like around 30 degrees. We went down Mornington Peninsula and Mount Martha and went for a swim in the ocean there. And up in the Dandenongs and had a picnic up there on Saturday. So Melbourne's a great place.
Yeah, if you're a bit younger and you're listening to this, you've got all that to look forward to. I seem to live my life more or less on a permanent loop these days of going to zoos and aquariums and the beach, just trying to rotate, find things to do. Challenge this weekend, half of Brisbane was up in Sunshine Coast for Easter weekend. In fact, we went down to the football just before the long weekend. There was more or less a constant queue of traffic from Noosa all the way down into Brizzy. And the weekend was crazy busy, obviously. We went out to the national park actually to go for a swim at Condalila Falls, and we were going to pick up some donuts on the way at Kenilworth Bakery. The queue was unbelievable. It was half the way back to Noosa. So it's almost a victim of its own success, that business, and you couldn't get in. Basically, there was a 200-meter queue. It's a very interesting story. I mean, that business has been around for 100 years, and about 5 years ago, they started this 1 kilogram donut challenge, which my kids are always trying to get me to do. Like, buy this like massive, the donuts. If you haven't seen them, they're ridiculous. And it became a bit of an instant internet sensation. They had 4.5 million views in a day or something. And it's actually it's amazing how many times you hear this story in small business is that people just plug away for years and years doing one thing, and then suddenly it just takes off. It's compounding of sorts, I suppose, and something gets traction, and then people build on the traction, and then people hear about your business from word of mouth, and then things just suddenly compound and take off. And I've heard that story over and over again from people running internet businesses, personal trainers, people in real estate. Just something. Things don't seem to be working all that well, but eventually they just rip. And there's multiple stores now of Kenilworth Bakery. Alas, didn't get to go there this weekend. It was too busy. So, but I think there's a point there, and that is that despite everything that the economy's had thrown at it over the past 18 months, there's still the people are out and they're spending. So, there's record household wealth, but that has another implication, and that is that interest rates might be out higher for longer just to curtail some of the excesses.
Oh, absolutely. And I think it goes down to good old-fashioned business values, right? You've got a quality product that you produce and you got good service and you keep delivering that over many years. You ride the downturns, right? Because people want to support you. They don't want you to go out of business. And then you do really well in the boom times. A friend who's got a buyer's agency, he's been in business 10 years. That's their values, to be honest. Very early days, no marketing actually out there. It was all around just great customer service, and our clients will be our best marketers, and they'll refer to us. And, they've done extremely well over the last 10 years just by, being consistent and offering great customer service. And so like you, Pete, I'm always sort of like when I'm out and about, sort of like listening to these stories, because, sometimes a place could have the great location, could have all the ingredients of success, but then it's up for sale and it's struggling to get customers. And you just got to think what's gone wrong here. So what's the 3 stories we're going to do this week, Pete?
Yeah, I was just thinking about personal trainer I follow called Joe Wicks in England. And he said that for years, he used to stand around giving out leaflets at train stations. And he sent emails to his list every day, 0 zero interactions on the internet for years and years. And now he's the absolute king. He's been on the honours list, and he's doing personal training for kids in schools, and he's just basically the king of the industry. There's another guy, there's a rapper called Zuby, who started out on the south coast of England, just basically giving out records one-to-one. And these days, he's got a massive internet following, over 1 million, but it takes a lot of persistence sometimes. And yes, there's a survivorship bias thing here, because you hear about the success stories, but sometimes you've just got to stick at it and stick with your values. So yes, let's get on to the 3 stories. What's the old quote? It takes 20 years to make an overnight success. Eddie Cantor. And I think there's some truth in that. People think, you got lucky, or, things went your way, but sometimes it takes 10, 15, 20 years to actually really see those results take off. So 3 news stories of the week. ABS released its latest finance and wealth figures for Australia. Household wealth at a record high the end of 2023 in the December quarter. So some lessons there on compounding, and we'll just look at the historic figures and what happened in the financial crisis and the lockdowns and things like that, and see if we can take away a few lessons or learnings, as people seem to say these days. Second story, huge land tax increases coming down the pipe. In Queensland this week, Moreton Bay released its, the council put out its latest land valuations, which are used for land taxes and rates and so on. And golly, some big increases there, 60, 70% in a lot of cases. And then another Queensland related story, but it has wider implications. Brisbane River market records the fastest recovery in its history. Flood zones and areas at risk of flooding are something we're always very cautious about, I guess, on these podcasts. But we'll take a look at what's going on in the housing market. CoreLogic put out its March figures today on the day of recording, and some more insights there. So, Chris, let's start with this household wealth figure. So ABS puts out these figures quarterly, and it's interesting to look back. In 2007, Australia's household wealth fell from 6 trillion to 5.3 trillion, largely due to a massive drawdown in the stock market. In 2023, household wealth rose 7.8%, more or less the same as housing prices, actually, to a record high of 15.7 trillion. I think the lesson here really is that, yes, you've got to be sometimes cautious and respect downside risk. But actually, as Charlie Munger once said, you don't want to interrupt compounding unnecessarily. I saw a video on YouTube this week, we'll link it in the show notes, from Charlie Bilello, who just really did a YouTube 5-minute video on not interrupting compounding. And as he said, Warren Buffett's net worth the age of 65 was 3 billion, and today it's 138.4. So 98% of his wealth has happened after the traditional retirement date. And it's just, he just goes through the reasons why people don't keep compounding. There's fear, recessions like the GFC. Sometimes people don't have a strategy, lots of doom and gloom forecasts, or people trying to be too cute timing the market. And sometimes, like, life gets in the way. You lose a job, a business, relationship, separation, or you need some emergency expenses for an operation or something. But yeah, I mean, they say Australia just keeps powering on, and that's nearly 16 trillion of household wealth, which I guess is why the bakeries are still full.
Yeah, and it's a big number, right? I think sometimes you can get lost in the numbers and think, oh, well, that doesn't really affect things. And, but that wealth is somewhere. A lot of it is in housing, in fairness. I think the Aussie residential housing market's worth $11 trillion, right? And a lot of that wealth is in the 50, 60, 70, 80-year-olds, equity in their home, because there's only about $2 to $2.5 trillion of home loan debt, right? So there's $7-8 trillion of property wealth. And a lot of that's actually coming down now through the generations. A lot of money in super and shares. I think, unless you're super, super wealthy, you're not passing that money down so much. You're using that to, give you a tax-free income in retirement. You're using that to, your lifestyle spending and things like that, I would say. But I think a lot of that property wealth in particular, that property equity, is starting to come down, and it's, unfortunately, it's not very fair, right? It's not like it's evenly spread. And I think if you look back over the last 5 years, you would say that the upper quintile has done a lot better than the bottom quintile, right? So that wealth gap's got even bigger. And I think this is this early inheritance, this intergenerational wealth. A lot of them are saying, well, why would I want to give this money down in 10 or 20 years' time? If my kids or my grandkids are in, stable relationships, and I'm not so much, I've got grandkids, for example, or great-grandkids, I'm not so much worried about, the divorce and money leaving the family, which is usually one of the big concerns. And they're passing it down earlier because they know if they don't, then their kids and their grandkids may have to leave the capital cities, may be making big sacrifices that they may not have to. And I think that's definitely my observation here. I also agree, Pete, all your points you said around compounding. People do get impatient. They chase short-term returns. They try to trade in and out of markets. They get spooked with volatility. They, maybe don't even capture that full return because they've got it set up in the wrong structure, or they're paying for active management, and then they're losing money in taxes. So that constant trading eats away into their profits. And then they don't really have a way of consistently, building that wealth. They don't have a consistent strategy to save. So they might have put some money in, but then they don't reinvest the dividends. They don't top it up with regular saving plan. They don't understand how to use equity in their home, etc. And so I think a lot of the compounding opportunities missed just because people don't, do all the 1%ers that increase that compounding rate. But obviously what I always notice a little bit more and more that I've been following the market is when people start to do well financially, whether they win lotto or whether they, do well in a business or through their employment, a lot of that income or that money that they make or they inherit goes back into the residential property market, and there's this consistent sort of overconfidence, mental accounting. The people, when they do well financially, they want to buy a better lifestyle. Yes, they buy cars and boats and things like that, but housing is investing in housing and residential assets is seen as probably one of the safest bets. The commercial property market's, a dwarf compared to the residential property market. Yes, people enter there if they've got, 5-10 million plus. There's definitely, advantages over the resi market, but I think that would be my observation with this story is. And I think over time, you can't, if you look back in 10, 20 years' time, that number is going to be a lot more than it is today. And there's going to be scarce markets around the country where people ultimately want to live are probably going to still stay really scarce. And so you can look at those two things to have more confidence around where prices are going to go long term.
Then when you look at the stats, as you pointed out, there's about 10 trillion in residential real estate. There's about 4 trillion in superannuation. And then you've got stocks and shares, currency and deposits. That's probably another 3 or so. So it all adds up. I think Charlie, in his YouTube video, sort of matches out a graph of the S&P 500 in the US, the biggest, stocks and shares. And I think, as you said, it's a bit similar with Australian real estate. You look back at prices 5, 10, 20 years ago, and yes, there are downturns in the graph, but overall, the trend is higher. I think it's also interesting there where you look at the shape of the graph for assets over 3 decades. And you went back 30 years ago, about 2 trillion, and today it's about 19. It doesn't go up in a straight line. It goes up, it compounds. Now, of course, the population gets bigger over time, and that's part of it. And also, there is the compounding effect that really, and this is where people say sort of money goes to money. It's true. You think that high net worths, they're compounding their wealth through the cycles, and it is somewhat unfair. I guess it's skewed in favor of people who own assets. But there's always going to be downturns in the graph. I think, you mentioned some of the risks there. That's right. Trying to chase the latest fad. I think it was Evan Lucas in his book Mind Over Money highlighted how the most likely people to go bust in life are the next door neighbors of lottery winners because they see somebody else getting ahead and they're like, I must get on board with this. And that's not really, when you look at these graphs, it's not the way to think about it. The time in the market can do tremendous things. And I just look at those figures for Buffett. He's compounding his wealth at 20% over the long run. But 98% of his wealth came after the age of 65. It's a pretty interesting thought that you might get to 65 and then increase your wealth 50 times further from there. But if you stick at it, and if you're lucky enough to live into your 90s as he has, then that could be the case for you too.
Yeah, I think Buffett's going to give it all away, right? I think he signed up to the Giving Pledge. If you haven't sort of looked at that before, I think there's a lot of info, interesting info online if you type that into Google. And, they're giving away 99% of their wealth. Buffett was like, well, I'm not going to give it away till I die because it's going to be worth the most then because I'm going to compound it. So that was an interesting play. Other people like Gates, et cetera, are giving it away as they live because they want to see the impact of it. Buffett said, I just want to focus on one thing, and that's growing that wealth. So, it's an interesting world, right? And I do think that, the best investors not only, understand compounding, but they also make sure that they get the best return with that compounding. So they understand that it's not just, trading shares or paying taxes, or they focus on getting good quality properties over, cheaper ones because they understand they're going to hold things for the longer term. The interesting point with this as well is that household wealth's at the highest. A lot of that is to do because it's very resi property heavy, and residential property's done really well in the face of, crazy interest rate rises, right? So, there's a lot of articles out now saying 20+% growth in, housing resilience and the growth in the property market's really going to slow down the chance of a rate cut this year, which just defies belief, right? Defies belief that, when property's under this huge headwind, tightest borrowing capacity we've ever seen, and the highest rates for some time, it's still proving to be really resilient and still got FOMO and supply problems, and people are willing to stretch. So, let alone when borrowing capacity is up much higher and rates are getting cut, you have to wonder what would happen then. So, what's number 2, Pete, on the story list?
There's an interesting point there with Buffett and the Giving Pledge, because his first wife, Susie, before she passed away, they often had this debate, I guess, where she thought that they should give away more money sooner because you could do more good sooner and that could compound. Whereas Buffett's view was, well, if he could give away 150 or 200 billion in the future, then he could do more with it that way. There's no right or wrong to that, but it's an interesting question. But I guess as somebody who understands compounding is somebody who's just kept on going with it. So second story, well, this is the flip side to the strength in the housing market. There's no free lunches in economics, as they say. Huge surge in land taxes in Queensland. So Moreton Bay Council put out to property owners their latest land revaluations. A lot of people have sort of direct messaged them to me going, what the F's going on here? So and I've seen plenty of examples of people have direct messaged revaluations up 60% in a year, sometimes 70%. A lot of people got 50%. What does that actually mean? So I guess having observed these things over the years, they don't often go down. That's one observation. Even if the housing market's doing badly, the land revaluations never really go lower very much. Anyway, they're very sticky. But generally, this will mean higher land taxes ahead for property investors. Probably this will be reflected in higher rates as well. Now, this is only the Moreton Bay Council I've seen this past week, and not every council does them every year, but you can expect to see this reflected all around Queensland because there's infrastructure projects to fund, like new rail lines up the sunny coast, or the cost of some of the COVID facilities and things like that need to be paid for. Now, I think there's a potential chance here for the Liberal government. They could snooker the Labor government by basically freezing rates or campaigning on that. And there's an election coming up, so that'll be in focus. I think in terms of the housing market, we've already got record low rental vacancies across southeast Queensland. And this is probably just going to add pressure to the rental market. I think if you're jacking up the costs again for landlords, we've already seen, as you mentioned, higher interest rates. They got higher land taxes. There's been also increases in costs for things like insurance, property management, other parts, repairs and maintenance. And it's not really encouraging landlords to provide affordable rentals. It's going to have the opposite effect. So there's some pain here for people who own substantial land holdings, I guess, in Queensland. And it's not going to help the rental market, which is chronically tight, certainly where I'm based.
I think this is absolutely attack on land, right? And land that, investors own. And so, I think this is happening in Victoria a lot. Now we're talking about Queensland. So it can happen in terms of changing the rate of land tax, but it can also happen in revaluing land. I think this is what this article is sort of pointing to, is that when people are getting their annual land tax statement, last year it was 300, now it's 500, right? And hang on a sec, has the land actually gone up that much? And some of them do averages over a number of years, and there are ways that, because they don't really want to have arguments with every single investor and every investor calling them and arguing around the land tax value. But I think what it is doing, though, is that maybe there was a bit of a free kick there in the past for investors because councils wouldn't focus on it too much, but maybe they're going to say, hang on a sec, I'm going to really try to value this land on what it's actually worth. And that's a big difference, right? If I look at, and just looking at previous experience and looking at people's land tax, it's usually a pretty conservative number, right? And you wouldn't sell it for that amount that you're having to pay land tax on. So are they going to get revalued? Are the land tax rates going to get changed? I think absolutely. I think this is going to happen in Queensland. It's going to happen in New South Wales. And they're going to force investors out of land. Are they then going to move it to homes? There is a state government push to basically make away from stamp duty to land tax on the home. And so maybe this is part of that overall story. Can we get our land tax up on all our investors first? And then once we've done that, do we then attack homes, start to shift people from stamp duty to land tax, and move it away from something that's very cyclical, and turnover rate of property is actually reducing every year, right? So you don't, from a business model point of view, you don't want your revenue to be based on something that's actually reducing, the number of transactions to be reducing, right? Because you can get an increase in revenue because prices are going up, but you're not getting it because there's more transactions. And so the state government is much better, and particularly in downturns, right? The supply really dries up. Everyone sits on their hands. So it's very hard for them to forecast their revenue. If they get a lot of money on stamp duty and it's very volatile and it's reducing, whereas if they can shift it to land tax. But there's a big jump. There's a big move from the sugar hit of annual, stamp duty to land tax. But I do think that there's going to be a movement to that, and upping land tax across particularly investors is going to be the play, because if you can force investors out of those, then it creates more for owner occupiers, but also it maybe creates more opportunity for investors to come on in and knock those houses down and build multiple townhouses and things like that. So I do think that's their idea behind all this. However, the investors who own the properties right now are going to be like, hang on a sec, this is another attack at me. And they're having a difficult decision. Do we hold it or do we sell it? And that's what they're trying to encourage.
Land value taxes, or LVT, been in the news again a bit recently. I think when you look at the comments on these articles, it's not a popular idea with people who own a home. I think people like to feel like they own something, they don't want to be paying big annual taxes on it, but there's definitely going to be a push in that direction. There's a little anecdote for you on affordability. A little unit I was looking at in Chermside on Farrell Street, or probably Farrell Street, as people say these days, listed for sale in 2020 during the peak of the panic. 6 months on the market, 235K was the asking price. No bids in 6 months, taken off the market. Relisted this week, sold in 3 days, 7 offers, sold for 490. So I just wonder whether some of these affordability issues are pushing more people into units, not just homeowners, but particularly first home buyers. But also, some of the investors as well. I think if land taxes are going to sort of crowd some of the investors out of the higher value markets, or people who already have a land tax bill, they might be pushed into lower price points. But just interesting to see in Brisbane anyway, unit prices are moving, really shifting now, which we didn't see for 12 years. I just wonder whether maybe Melbourne is due as well, because I guess over a dozen years, unit prices haven't really budged too much. And maybe Sydney as well, probably 7 years without much price growth for units. So I think, the higher land taxes could have some implications in that direction, maybe just pushing people into the lower or more affordable price points.
Yeah, I think that what Melbourne needed is no more building, right? And it also needed house prices to go up. And then the final thing is it probably need people kind of borrow enough money for houses, so they're forced to buy apartments. So borrowing capacities to fall. I think that's what's happened in Melbourne, right? So, you've got houses have done quite well. Haven't gone up a lot, but then they have gone up enough, more than apartments. There's been a real reduction in building, right? There's no more towers everywhere compared to what there was 5 years ago. And then I think that rental vacancies have really started to drop down there as well. So it's forced people to want to, less options to buy means to force you to want to buy something. And, things I think like the stamp duty exemptions and things like that down there as well. So I think the apartments are finally having a bit of a good run. I think in Brisbane, similar thing, that stories happened up there as well, where people are forced out of the housing market because of borrowing capacity, because they've gone up in value. And then they're like, I don't want to rent, I actually want to own something because I'm worried the market's going to run on me if I don't own something. Let's get a good apartment instead. And there's been less building up there the last few years. And so, but I think it's all cycles. I think ultimately once apartment prices go up, feasibility starts getting better for developers. And then, there'll be a demand for new stock. And you'll start to see another building boom, absolutely, in Brisbane and Melbourne, and Sydney as well. I think there'll be another apartment building when those numbers can stack up for a developer. They're not going to just not build. They're going to try to capitalise up, particularly in, say, New South Wales, where there's planning controls changes, and where maybe you couldn't have built 2 years ago, but you can build now. I think that's all happening in the next couple of months. Those feasibilities are going to start to quickly stack up, and you're going to create another little mini building boom.
It'll come around again for sure. There's definitely a cyclical element to all of that stuff. And the time will come again for the next construction cycle, a construction boom. I saw insolvencies close to decade highs now, driven by the construction sector. So those are ASIC figures just out this week. So Chris, final story of the week, Brisbane River records the fastest recovery in history. So this is an article in the Australian. I think, the river market sales, there was a bit of a boom period in 2021. In 2023, there were 47 absolute riverfront sales, well up on the 32 achieved in 2022. Average price around 4.5 million. But in recent months, we've seen the first 20 plus million riverfront sale. That's Wellesby Street in New Farm. And I think there was a flood event in 2022, and this used to put people off for years, but this time around people have just gone straight back in. That's quite interesting to see. We've seen 3 sales over 10 million in recent months, so according to the Australian article, we're seeing a lot of big money spent to the top end of the market. I think just an observation that I've made as compared to other parts of the world, I think properties with water views in Australia tend to almost have their own cycle. They march to their own drum a little bit. It's very, very highly sought after. If you've got an ocean view, a river view, or something like that, that does tend to make it, so it's a real point of scarcity that people really sought, or, is really sought after. But I guess the buying absolute riverfront, there's clearly pros and cons here. There's a market timing element. You've also got risk. You've got sleepless nights if there's catastrophic weather events. You've got insurance premiums are only going to go up, I guess. And then potentially even, climate risk, so it's something that's talked about a lot. If flooding events become more regular, you've got that to worry about. And this is actually true, not just for houses, but even for unit developments. I used to live in New Farm, and there were some of the unit developments actually got water into the basement or the car park, and that, wrecked the electricity, and also just puts people off buying in those developments. So I think, it's interesting that people have just shrugged off the latest flooding event within 2 years. But, you've got to be really cognizant of what you're doing here, because those insurance premiums aren't going to go down for waterfront, I guess.
Yeah, I mean, the short-term bias, when you're in the thick of it, no one's ever going to want to live here. They're going to remember the flood. And then, a year or two later, people have forgotten about it. We did an interview on The Elephant a few years ago. Apologies, I forget her name. Margaret Cook, I think it was. The city with a river problem. And, not every flood's the same, right? Because the water lands in different locations and it banks up in different ways, and, and affects certain parts of Brisbane worse than others. And, and I think that was a really interesting observation for me. I guess ignorantly thought, every flood's the same. You can just look at past floods, and no, that's not the case. Some parts, maybe they didn't get affected in that flood, but maybe they've been affected in this flood because where the water landed. And so, and I think, that's safe to say, okay, well, 1 in 100 year floods, is that really 1 in 100, or is it 1 in 5, or is it 1 in 10? I think the last, decade or so has proven that, multiple 1 in 100 years floods in 5 years. Well, I don't think it's 1 in 100, right? So, I think that short-term memory, I think people moving up into states probably driving this as well, Pete. There's an overconfidence bias. It's just they haven't been through a flood. Unless you've been through something, you don't really understand it like someone who has been through it, right? Like it's very hard, no matter what it is in life. And I think a flood or a serious event like that is, once you've been through it, you are a little bit scared about going through it again. And so maybe the locals are a little bit hesitant, but maybe that interstate expat money coming back into Brisbane are a little bit oblivious to it. And they may be like, oh, yeah, should be right, mate. Let's just go ahead with this. Insurance is the big one there, right? Like if you cannot get insurance on the property because, and I do think insurance companies are going to become more and more picky. I mean, end of the day, they're a business. If they are losing money in certain pockets and certain types of insurances, they're just going to pull out of the game, right? And so you're going to get a much smaller number of insurers wanting to play in certain markets. When you've got a demand and supply imbalance, obviously the cost is going to go up. And if you have that catastrophic event where, flood happens, plus you can't get insurance, good luck trying to sell that property, right? And I think that would be my concern here is, it seemed like a great financial decision up front, right? A scarce property, riverfront, Brisbane. Look what you can get for your money versus overseas. However, one bad storm and then you're really regretting your financial future.
You don't want to limit your resale pool, I suppose. That's the thing, because people might be scared off by a $10,000 insurance premium, or as you said, or in some cases, no insurance premium, which becomes unviable. Just to wrap up on this one, quote from the article, New Farm also recorded 32 riverfront apartment sales valued at $125 million in total. Kangaroo Point had 16 valued at $51 million. And 5-unit sales in Brisbane City at a total of $12 million. So riverfront is also apartments these days. The highest sale was in Maxwell Street, New Farm, for $8.75 million. So there's some big money there for going into units, the ones with river views and water views as well, particularly in the blue chip areas. So I think just to circle back to the earlier points here, because we've got record household wealth, and that's as you said, it often gets reinvested back into residential property. These days, not just houses, also premium level units as well is seen as a store of wealth, I suppose, for a lot of high net worths. But this record household wealth is just causing people to question whether we could get interest rate cuts or whether they need to be pushed out. I was chatting to Andrew, who I work with, and who you know, and he was saying, well, the problem here is that if APRA cuts the buffer, for lending assessments, and then you get tax cuts on 1 July, and then you get interest rate cuts. Well, you're just going to tee off another massive housing boom for prices, and that's not really what the policymakers and regulators want to see at this point. So, yes, the wider economy might need some stimulus, but if it just ends up teeing off another housing price boom, that's not really necessarily desirable. And all of that might just push out the case for monetary easing.
Yeah, absolutely. I mean, Andrew's a smart man. He understands the lending game very well. And absolutely, if you start to do those three things, tax cuts, borrowing capacity increases with APRA, and I can't remember what the third one was.
If you get interest rates fall as well, if you get a trifecta of things, this just harks back to 2019. We got three things that teed off lending in the space of a week. We saw the election result, which changed tax policy, and then we got the APRA changing regulations, then we got an interest rate cut. Before you know it, everyone's back in. I'm sure regulators are well across that risk. They don't want to tee off another mania or frenzy. So, if you look at markets, they are generally pushing the potential for rate cuts further out towards the end of the year, even in the face of 10-year highs in insolvencies for construction and retail and things like that. And for now, anyway, the jobs market seems to be holding up pretty well.
Yeah, absolutely. I mean, that's definitely what we've been speaking about for many months on here. And absolutely, I think that would happen. Any borrowing capacity increase will very quickly get factored into prices. I do think your point around the high-end apartments is something we didn't sort of talk about before. And absolutely. I mean, I was just reading an article then about, the Gold Coast Marina there, and the amount of money that's going into some of the apartments there. It's almost like the Manhattan effect in Australia, where, the wealth is sitting in that cohort that does want that lock up and leave, but they've got kids and grandkids that usually come to their property for Easter and Christmas. And, they want the grandkids to come to their property rather than going to their tiny little house that their kids or their grandkids have got, right? And so they want a big place, but they don't want to the maintenance and the upkeep of the house. Generally speaking, they want to stay in the suburb or go to a lifestyle hotspot like, say, Gold Coast. So they want something that's within where they currently are in the housing market, but they want a bigger apartment. They want a sky home. And those type of apartments, absolutely, they're completely undersupplied because they just weren't that desirable in the past. But people with that money would go and buy houses. But there's that shift in the demand as demographics have got older. And that's where developers having a bit of a field day, right? They can charge these enormous, amounts that are way more profitable for them than if they were selling them at $1 million apartments, because they can sell $8 million for a penthouse apartment or a whole floor apartment, because there's this real wealth in the cashed up downsizers. And they usually are buying in scarce, they're beachfronts or they're, waterfront, or they're on the best locations within premium suburbs where development controls are really tight. They're not in areas where they're building lots of apartments. Generally speaking, that just doesn't give them that scarcity. It's not what they want. And so, interesting point out, just article here as well, Pete. I'll throw it in because we've got a couple more minutes to go. But there's a bit of there's a movement to basically shut down golf courses. I know you like your golf. What's your thoughts on more and more golf courses? I was driving past quite a few on the weekend. I was thinking, God, that's a lot of land. That's a lot of prime land that could turn into houses. We've got a rental affordability crisis, a housing affordability crisis, homelessness. Why can't we just turn that into houses? Surely the golfers wouldn't care that much. What's your take on all this?
Oh, I think for some of the courses that aren't viable, it's definitely, every time I drive through Coolum, I think that's going to go for housing. It's just a prime location. It's near the beach. Not that many people use the golf course these days. The facilities haven't been invested in for a long time, probably for that reason. So, I think there's a move in that direction. There's always pros and cons. Just looking out the window here, you've got kangaroos, koalas, lorikeets. There's a lot of wildlife there that, that's going to get wrecked, if the habitat gets built on. But, as you said, there's a big demand for more housing, particularly rental housing. So I think for some of the golf courses that haven't really attracted big memberships and they haven't reinvested in the facilities, I think that will be something that's factored in. I'm very suspicious to see Moore Park in Sydney, half of the golf course being clipped away for apparently parkland, but we'll see what happens to that because these things have a way of morphing. There's interesting stuff. And I think we maybe talked about a week or two ago. I think, yes, unit supply might be a decade lows, but not at the Gold Coast. A lot of developments are getting out of the ground there, I think, because of the water views, the premium prices, and also a lot of cash buyers at the Gold Coast. I think downsizes, as you mentioned. So let's wrap up on those three stories then. So record household wealth for Australia. I think that's continued in Q1. CoreLogic reported a 1.6% increase for the March quarter in housing prices. So you've got shares at record highs. You've got superannuation and housing prices. So household wealth, as we sit here today, is as high as it's ever been in Australia, probably 16 trillion. It's a lot of capital around. Secondly, huge land tax increases for Moreton Bay Council in Queensland. I expect we'll see that reflected across southeast Queensland over the next year or two, which will mean higher land taxes and higher rates ahead. And then thirdly, Brisbane River market records its fastest recovery in history. I think these stories are all in some way linked. There's a lot of wealth around there. And I think people have seen that some of the downturns haven't lasted that long historically, and people have just looked through it, basically. And that the same applies to some degree to interest rates as well. I think even after the fastest tightening cycle that we've seen in modern history, housing prices have more or less shrugged them off as we sit here today in 2024. So that's about it from me, Chris. Anything else you want to wrap up there?
No, that's it, Pete. And absolutely, we've had a few negative comments on that we do a bit too much promotion on this podcast. So hopefully we don't. That's not our intention at all. If you do follow us each week, that's not what we're about. But absolutely, if you want to get in touch with Pete, check out his blog. And they're doing lots of buying around the country. And check out in the show notes if you want to talk to us about mortgage broking and what we can do there for you as well. So thanks so much, Pete. Looking forward to this chat already for next week, mate. And happy Sunday to all our listeners.
Pleasure. Thanks, Chris. Yeah, you can catch me on Twitter as well. One of the pros and cons of social media is you can get some pretty direct feedback and pretty quickly. But yeah, the internet can skew a bit negative sometimes. What did I say? 40% negative comments or something like that. I think my Twitter feed's more like 80. But yeah, it's all good. Yeah, always good to hear from people. So yeah, you got any questions, fire them in, and always look forward to our Sunday chats, Chris. So have a great weekend, everyone. We'll see you next week.
See you next week. Thank you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.